The other thing that you're famous for is for the mergers and acquisitions that you've done in your life. At the time of you retiring from Wells Fargo, it became a $1.3 trillion institution. At a time when Norwest bought Wells Fargo, you were $20 billion, about there.
When I started Norwest, the time we bought Wells Fargo, we were $100 billion.
$100 billion,
but
right.
when we started we were
at
20
billion.
20 billion. Yeah.
So this kind of scaling, what is sustainably achievable in scaling, especially with the hindsight that you also need to be customer centric, you need to have consistent proposition, and all that you've said about incentivizing your staff and so on. What's achievable in terms of scalability, and can a Wells Fargo continue to grow?
One of the misconceptions is that large is bad and large is risky. Yet more small banks fail than big banks. So why? I would argue that at $1.3 trillion today, with 100 different businesses, 20 to 25 individual products throughout all of the United States, that Wells Fargo today is less at risk of failing than the old Norwest, which was basically a commercial bank, very narrowly focused in the Midwest, very dependent upon, directly and indirectly, on agriculture, which almost failed in the 1980s, which is how I got to Norwest. It was a troubled institution that I was asked to come in and try to help, correct the problems and so on.
Right.
So, what we have done is at the old Norwest, and it's still we have a little more market share today. But let's say that the old Norwest, in the 5 states that we were doing business, we had roughly a 10% market share of banking. Today, in those same 5 states, our market share may be 15% of banking, 15 to 20% of banking, but we're still bigger than that because we're in financial services. But we only have about a 5% market share of the financial services market.
In terms of total assets?
Well, however you want to define it, revenue, assets. We won't get into that's pretty complex, but it just however you want to define it.
Right.
The financial services business is about 5 times bigger than the traditional banking business. So if you get bigger, if we went from $20 billion in assets in Norwest in those 5 states to $1.3 trillion in assets in those 5 states, we would be much riskier and at risk of failing. But if the reason you have grown is you went into new states where you had 0 market share
and built it
to this 10 or 15%, why is big bad? And the reason small banks fail is because they're usually not only in one state, they may only be in 3 cities. And if a plant closes down or whatever,
out, yeah.
That's why they fail. So
diversification.
So I would argue geographic diversity. Remember the Texas banks back in the 80s? They were some of the most profitable banks in all of America. They had the highest PE ratios, and so they all failed because the state failed.
And the oil industry.
S&Ls.
Yeah.
Remember the S&L crisis? They failed because they were concentrated in 2 products, commercial real estate and residential real estate. They weren't big, and yet everyone says big is bad. Concentration is bad, and the bigger you are in concentration, that's even worse. But if you're big because of diversification, it reduces the risk. That was my point of why we got into financial services. If we wanted to grow and with the same product line, we were going to get more risk. And I said, I don't want more risk. I want less risk. So I've got to diversify. But that then allows you to grow without taking more risk. And that's what we have today, is we basically now have the 10 or 15% that we still have in those original 5 states in 37 states.
Right.
and we've gone from just 2 or 3 products being offered to offering 20 or 25 products, and that diversification actually reduces risk.
Is this Wells Fargo franchise that you've described, is it uniquely North American? Is it uniquely American in that we would not find a Wells Fargo becoming international in its core consumer franchise outside of the U.S.? You mentioned Walmart, and Walmart has been sort of a touch-and-go case outside of the U.S. A lot of learning experiences in China, and it's not been that straightforward in Europe as well. So, is the American consumer banking franchise of Wells Fargo, being mindful of the fact that you are a great trade finance bank outside of the U.S., right. You've got great people who do the legwork and go and meet people and so on.
We're number one in the world in that, as a matter of fact. From the old Wachovia acquisition, actually. It wasn't Wells Fargo that did this, but when we acquired Wachovia, we acquired the Financial Institutions Group.
So you're adding complexity to your institution. So it's not, the core proposition is not as straightforward as the Wells Fargo of San Francisco. The diversification has brought other forms of businesses which are becoming equally large, or, I mean, not equally, but significant with the balance sheet.
Well, you have two choices. Do you want to do something that you've been doing all along and know how to do it and become concentrated? And therefore, I say you're going to have more risk because external factors. You can still run that very well, but external factors can do it. Or you can trade off risk, let's call it credit risk or whatever, for operational complexity. Operational complexity you totally control. A macro event is not going to cause your operational complexity to blow up, right? But an economic crisis, which you have no control over, could cause all kinds of your businesses to go bad. So I would rather trade off things I can control to reduce overall risk than things I can't control. So the quick answer is Wells Fargo will not, I'm not in charge anymore, but I think it's very unlikely, will grow retail-wise internationally. As you said, we already serve financial institutions, and we're also going to start some commercial offices, commercial banking offices overseas to serve our U.S. customers. But we're not going to do local business, to any great extent. And the reason is we still have tremendous growth opportunities in the U.S. But, I used to run Citibank's consumer business internationally back in the 80s. The truth of the matter is there's many more similarities between commercial and retail banking internationally than there are differences. So the skills can still transfer.
Between countries, between regions?
Between countries and between regions. When I was running the New York banking division for Citibank, before I ran the international, I used to say after international that there was greater differences between the retail banking business in the Bronx versus Manhattan than there was between New York City and Hong Kong. That there's really, people want to save and borrow and have a mortgage and have a credit card all around the world. The difference is the culture of the organization, and it's just much easier for us to first expand domestically and get our market share than to try to establish a relationship or acquire a company in a international situation. So I don't think that will be on our agenda for some time, and maybe never, maybe for never. It'll depend.